If you knew that a stock was going to drop at an extremely greater than expected move, if you knew with 100% certainty, and not only that, it was going to do it in one day. Like, you knew, you had 100% certainty that the stock was going to bottom, and you knew it was going to happen in one day, guaranteed. Thank you, Zlatko, what is the number one and the only strategy you would ever do if you knew with certainty? And I mean any stock. Right, you would buy a single put because there's no better way. You wouldn't buy the stock because you've got no leverage. Buying a single put or 1,000 puts, right? Whatever your allocation is. Yeah, buying a put is the best investment on the planet if you had a 100% certainty that you were going to have an extreme greater than expected move. Because remember, expected move is built into the price of the option. Trading stock has no leverage, right? What would be better? Buying 10 houses in the neighborhood with every last piece of cash you have if you knew the housing market was going to explode higher? Or do you buy, if you could, 50 houses using a mortgage? What would be a better return on your investment? Buying the mortgage, right? You're not going to want to spend full cash, or buy one multi-unit, or 10. The idea here is leverage and expected move, price of the option. So you need to have a big move, and it has to happen quick. So yes, the answer is you would buy a put. And because that's the answer, isn't that also the answer? What if you knew with a 100% certainty that price was going to go up? What would you buy? Wouldn't you buy a call? Absolutely. Now, the problem with this, if I buy the 350 calls here, or the 320 puts, they're too expensive. They were like $800 each. So that takes care of my $40 credit. $40 credit, $800 cost for the put. That doesn't work. And that's where these leveraged products come into play. So TSLL at the time of this particular trade was sitting at about $12.50. So I bought the 11.5 put. And I bought the 14.5 call. This 11.5 put was out of the money, which means if I get an unexpected drop in price, not only is the out of the money put going to pay me really well, but it's leveraged at 2x. If Tesla goes down 4% in the morning, this thing goes down 8%. So not only am I getting the huge out of the money move on a put, super cheap, out of the money, but a great return, it's leveraged at 2x. And guess how much these puts were? Well, I priced these particular options out because this one cost 30 cents. I priced out the 4.5s at 41. I used the credit received, the $81, to pay for a single call, single put. Well, I got 5 of them, right? So I bought 5 of these and I bought 5 of those. And so what's the net, folks? The trade paid me $10 per set, right? These, and these. I got paid $10. Now, let's talk about how much can you make and what's your risk, right? So we'll talk about how much you can make first, okay? I'm sure everybody's with me, and this is I'm coming to the end, and then I'm going to show you on the options chain real fast, and then we'll take a break and then get some questions. Okay, is this blowing your mind? I mean, this is just fantastic, is it not? It's complicated, it's layered, but once you understand, how the mechanics of it and what tickers you can use, it's really not that complicated. It's you have to definitely watch it again, but now you know what an unbalanced butterfly is. You put an unbalanced fly on top, way out of the expected move, where you can get a credit. You put it on, and I'm going to do one in the options chain to show you an unbalanced butterfly out of the money past the expected move. You take the credit and you use the credit to buy a straddle, but it's not really a straddle. It's straddle-ish. Right? It's kind of straddle-ish. I'm going to buy an out-of-the-money call on a leveraged 2x or 3x product so cheap that it's paid for, but let's watch the scenario. Okay, so here's Tesla 133. What happens if price never gets out of here? It goes up $3, $4, $5. Nothing really happens. Blah, 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 blah. Right? Nothing. Stays somewhere around anywhere between, say, 308 and 358. The trade's in the range. What happens? Expire worthless, this whole damn thing. Expire worthless, this whole damn thing. Do you think, ladies and gentlemen, that either the 14.5 call or the 11.5 put, based on the open in the morning, is going to have some value? Even it's not going to open at 333. This is something we know for sure. It's earnings. The stock is going to move. We just don't know where. So let's just say it stays within here. I keep the credit. So it's paid for this. Do you think that the calls or the puts might have some move? Something? $20, $30, $40, something. I mean, it's not going to be zero. So if it moves to the downside, whatever's left of the calls, just get out of them for $5, $10. And then ride those puts. And as soon as you see the buy the dippers start to come back in, you'll close that one and you'll make some money. Yay, you made money, plus you already are up $10 for the trade. Now, what happens into Thursday and Friday? What happens if price starts to move higher? Well, if you didn't close that call, maybe you just leave it open. So you take some money off of the put, but what if it starts to move up into Friday? Let it move. If it moves, the more you make. This call is just going to keep making more and more money into Friday. And if you get up to 360, you've now activated your unbalanced fly. In fact, if you kept the call, this thing could moonshot to 400. Can you imagine what your 2x leveraged 14.5 call would be worth if price went up to 400? You will never have seen a return on investment like 30 cents ever in your life, because this would be a 7,000% return on your money. How great would that be? It certainly would cover your risk, wouldn't it? And the same works down here. So if it moved a little bit, you cash in some of the call and put, you keep your credit, all good. If it moves aggressively to the downside, you can certainly sell that put and then see if you can get a credit for this and close that out, right? If it moves aggressively to the upside, sell the call and see if you can get something out of this. So you really have no risk. Yeah, Stone Guy, how can you lose on the UB fly, on the call fly? How can you lose if it goes to the downside? It expires worthless. You were already paid $40 for it. It just expires. How can you lose on it? Yes. Going above the calls. Yes, I just said that. You will lose you'll lose up to 4. Now, if you see price going up, close it. So maybe you only lost 200, 100, 200, 300. The only way that you would lose 460 is if price gapped up above 370. Chances are you're going to close this out at some loss. But it doesn't matter. If it closed inside the net, you make money. If it goes all the way up here and you're losing money on the unbalanced fly, you got the 14.5 double leveraged calls.
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comments section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.